What's going on, guys? Welcome back to my channel. This is Blood Phantom 81. Please excuse the nose. I had an accident playing basketball. My nose ran into someone's forehead. Blood started coming out over my hands. Some fell on the court. It was just like everywhere. It's pretty gnarly. For anybody watching that, I don't know what it must have looked like, but I should be good maybe by like next week or so. Anyway, so what I really want to talk about today is this idea of not really being sure what to do with your cash position when the market's at all-time highs, right? As I'm making this video, the Nasdaq's at all-time highs, the S&P's at all-time highs. I'm sure the Dow is also at all-time highs. Plenty of dividend growth stocks, large cap tech, even crypto. Well, some crypto coins are all at all-time highs. And so it kind of begs the question, what do I do here? So first things first, it would be dishonest if I didn't say this, which is the one strategy that you can pretty much almost always rely on. And of course, if I was more of a Boglehead, aka reference to Jack Bogle, who started Vanguard, if I subscribe to that philosophy a little bit more, I'd probably only talk about this. But the one thing you can always rely on is just dollar cost averaging into the S&P 500, and it's that simple, right? It is the strategy that for folks who don't want to spend hours upon hours doing investment research or just like getting ideas, things like that, tweaking their portfolios, and they want to sleep easily at night. Look, as long as you do two things, one is you don't panic sell, and two, you have a long-term time horizon. Dollar cost averaging into the S&P 500 is like the simplest thing you can do, right? So I never want to be dishonest about that. However, this is a channel where I do document my journey. I talk about different investment strategies that I do have. And so that's not really what I'm personally doing with my cash. I don't even know if I don't even think I own the S&P 500 at all, actually. Yeah, I'm going to give a few ideas and maybe some you guys actually like. And of course, this is not financial advice. So first things first, first strategy is I never truly think that there are no deals in the market. So step number one, what to do when there are no deals, is there are always deals. Now, what do I mean by that? So I would say that I probably have around 50 dividend growth stocks and large cap tech stocks that I love to buy more of whenever there's a deal. And so I would kind of recommend most folks to have that list, because when you look at that list, there's always going to be stocks that are getting hit, right? And that's just like the nature of the market. It doesn't mean those stocks are bad. Great companies, even some of the best companies, sometimes suffer drawdowns, right? And we all know this, right? That's nothing new. And so you guys remember, I did make a video maybe a couple weeks ago talking about McCormick and Clorox showing really good buying opportunities. So that's a couple of stocks that are in the CPG space. This is actually Clorox right here. As you guys can see, still showing a pretty good buying opportunity. And of course, there are some stocks that probably don't move as quickly and are probably a little bit more quick or easier to find deals. And what I'm looking at right here is Consolidated Edison. I believe Consolidated Edison has at least a 3% dividend yield, probably a 4%. And so that's one thing to keep in mind, right? Is when we're talking about cash positions, you can always have your cash working for you in the context of dividend growth stocks. The best part about dividend growth stocks, especially aristocrats and kings, which by the way, I spend a lot of time researching. I don't really talk about them too much, but I love them so much. So with aristocrats and kings, you're going to lock in that dividend yield and then always get a dividend growth as a result of that, right? So it might be like a 3% or 5% or 7% or 12% dividend growth. But you're always going to get more dividends after that, assuming that nothing really bad happens. All right, so what's the number two thing that I'd recommend in this situation? That would be, of course, selling put options. So with selling put options, obviously you get a premium. Let's go ahead and walk through what that might look like on Robinhood. All right, so we're looking at the Facebook option chain. I refuse to call them Meta because it's kind of a creepy name. And so this is an example of basically generating passive income through options. Now, let me make one thing clear. This strategy usually tends to only work better with high quality companies. And so, if you want to do it on large cap stocks, generally you have to have enough capital to do it. With Facebook at $338 per share, that's somewhere in like the $30,000 range if you do want to sell a put option on Facebook. And so for me, I would say options really don't start to make sense. I should say selling options don't start to make sense unless you have maybe like a six-figure account. There are other ways to do it, and especially like there's cheaper ways to buy options, right? Especially if we're talking about spreads. But just something to consider. I usually only stick with regular long, short call puts. I used to do spreads, but not really anymore. So you can see with this option chain, let's say you had $150,000 trading account. This is something to consider if you did want a large position in Facebook, which I'm personally not opposed to. So like today is currently November 8th, but if you want to look at some expiring over the next couple of weeks, you can see you can make $267 off a 320 strike. And so why did I pick Facebook in particular? So let's actually go ahead and take a look at a chart of Facebook. So we can clearly see here that Facebook is showing a pretty decent buying opportunity. We draw down from about $382 per share all the way down to about 307, now currently at 339, right? And so just goes to show when high quality is dipping, it really doesn't really last that long. But anyway, so with this stock in particular, the reason why I consider selling the put option is because I wouldn't necessarily mind owning Facebook around these price levels, but because it also dropped recently, that also means that two things. One is that it's almost like you're less at risk, as if you had sold the put option up here, in order for it to be called away. But the other thing is that you really do have more flexibility here, right? Because since Facebook has already drawn down, you say, okay, I don't mind owning Facebook around this price level. And so you have that flexibility now. If you want to buy it, honestly, like pretty close to the money, you can, right? Like you could probably sell a 325 and like I wouldn't even flinch at that. I would say, yeah, it's a pretty good deal. 325 gives you 380, right? $380 in premium. So that's something that I would consider. And it's not just the Facebook, right? Like even with stocks at all-time highs, sometimes it feels a little bit daunting to actually sell put options. But I mean, if you think about it, if you're going to be buying those shares at that price anyway, then it's probably okay. But again, it only works in certain situations. And the other thing with Facebook too is that it is a large cap tech stock, so you are going to get more premium if you do it on this particular stock than if you were to do it with like, Procter and Gamble or something like that. All right, so going back to the list, the third thing I would recommend is defensive funds. And so what do I mean by defensive funds? So it's kind of related to number one, except with defensive funds, they generally tend to be good deals year round. Whereas here, I'm really talking about like maybe, let's say, a handful of stocks out of 50 if the market's at all-time highs. Here, I'm talking like usually a good deal year round. And so one particular fund that makes this strategy work is actually NUSI, and it's something I just started to do recently, but this has a built-in hedge to it. Let's go ahead and take a look at NUSI during the March 2020 crash. As you guys can see, there hardly was any crash. Well, you can't really see it because my screen isn't showing, but Feb 2020 was here at 26, and then March 2020 was here at 23, right? And so really not much of a drawdown. And NUSI will pay anywhere from, let's say, I'll just be conservative here. I'll say like anywhere from 8 to like 10% dividend yield, depending on the month. And so you could probably expect 8% of a dividend yield, and just pay monthly. I currently own NUSI and I'm pretty happy with the shares. But again, this is just one fund. If there are other funds that you like with a similar profile to NUSI, then that's totally an option as well. Something else I might consider, which technically isn't as defensive as NUSI, but I actually prefer it for long-term growth, is actually QYLG. So let's go ahead and take a look at QYLG. If you guys don't know what this is, This is basically taking my favorite index, which is the NASDAQ, and then you're holding long shares on 50% of it and selling covered calls on the other 50% of it, which would give you around anywhere from, I'm being conservative here, maybe a 5 to 6.5% dividend yield, while also getting some capital appreciation. And on my interactive brokers account, I literally only buy QYLG just because I like it so much. And so, yeah, this is roughly the idea. Again, it's not as defensive as NUSI, and of course, if there is a crash, it's definitely going to feel the pain. But this is kind of one of those year-round type buys that I was talking about, right? So, going back to the list, this is more like a handful out of 50 high-quality companies. This is more like year-round funds. And the fourth option is simply cash, right? Like, it's okay to have cash, in my opinion. At the right time, right? Like, let's go ahead and take a look at the NASDAQ ETF. Let's go ahead and throw on RSI, right? So you guys can see here, RSI is pretty elevated. On the morning of, I think it was Friday, yeah, daily RSI basically touched 80, or maybe it was at 79 or something, right? And so that usually tends to not bode well for the stock market, right? And so if I take a look at the last time it hit 80, it was actually here back in September 2020. And then the times before that were actually leading into the February 2020 crash. Now, and the time before that was actually here back in April 2019. And the time before that was here back in January 2018. And so you guys might be wondering, okay, well, look at this period, right? Like the market can get overbought and stay overbought. That's true. That's totally true. But I think context is very important. If we think about this time period, for example, the market had been basically consolidating under this area of resistance for about, that's actually over a year, right? So over a year of consolidation. And then when we did get overbought, like it was kind of in the, I would say, early to middle innings of this breakout. And so, you know, this is probably, obviously hindsight is 2020, but this would give me less hesitation as we do now. Now, honestly, it's not that bad now. Like, for example, if I take a look at 2017, 2018, like this to me is more worrisome than what we have here, because we do have this area of support that we just bounced off of. But I would still consider this to be yellow light, right? Like this isn't an exactly inviting look here, right? Let's also take a look at 4-hour RSI. Let's see how overbought we got. So this is RSI of about maybe 84. Again, last time we had that was here back in September. And so, again, it's not really about like, oh, is this time different? It's more about risk to reward, right? Like generally, markets that are overbought are not the kind of places where you want to be buying. In fact, maybe you want to be a little more cautious. That's just me personally. Now, like I said, this is still not as bad as January 2018, because we just touched off this resistance, or sorry, support. And so maybe we continue to rally. I'm not sure, but still, this is some area for caution. Now, the reason why cash is even an option is because maybe sometimes you don't want any risk whatsoever, right? And maybe you don't want to just buy something and then sell it. I mean, I think the safest option besides cash is NUSI. And of course, people are going to say, like, well, cash is not safe because it's going to get eaten due to inflation. I mean, if we're talking about over a 5-year time period, like, yeah, consider doing something else with it besides cash. But if we're talking about 3 months, like, which is what I'm doing right now, I'm basically just doing, I'm doing all of these right now. And I'm not really scared of doing anything right now, because with cash, it's like, okay, I don't expect to hold it for another, like, more than 6 months. Defensive funds, I got you. Selling put options, I got that too. And then always deals, I'm buying dividend growth right now. So yeah, it's basically some ideas. You guys probably already knew this, but yeah, just hopefully this inspires people, and I'll catch you guys in the next video.